little 2-page exam. But yeah, so today we're going to finish chapter. And by the way, next week I'll have class, but it's not required, it's optional. So if you have any questions or anything like that. I like to give a good week at the end of the semester in case any problems come up. So anyway. All right, so today let's go ahead and get started on. Okay.
Hi, Professor. I'm sorry, I apologize for interrupting you, but
No.
I wasn't in class last week, but I just wanted to recap. So you were mentioning like this was the last. So are we going to have a final?
No, this will be the last. This will be the last.
This is it.
This will
Okay.
be the final thing.
This will be the finals. Okay. Okay. Just wanted to be sure.
Yeah,
okay, thank you.
There won't be a comprehensive final or anything like that. Yep, last thing. What are we doing here? Okay. All right. So so we looked at subsequent events, and these are kind of big in not only in just on CPA exam, but in real life, a lot of times they're big. Okay. So wrapping up the audit, a couple things: communicate misstatements with management. Now you always communicate material misstatements to management with hopes that they will change them. Sometimes management will ask you to communicate all misstatements. And as you go through your audit, a lot of times you'll find things that are wrong, they're misstated, but they're not material. And that's very common to have. So what you do with those, you write, you put them in the notes. And generally the senior auditor will determine whether they're material or not. You don't want to make a claim that it's material or something like that if you're just doing the test. Usually the senior will look at it. Now, if you're the senior, then yeah, make a judgment call. But yeah, so see if they're material or not. Now the client, truthfully, their financial statements will be fairly presented even without the immaterial misstatements. But they may want to know what they are, just to see what the problems are. Can you just give us all the misstatements you found, because I want to see what they are and maybe how to avoid them in the future. So and these are usually the actual misstatements, not the projected misstatements. And what I mean by that, when we do our sampling, we have projected misstatements, but they really don't tell you like which accounts need to be adjusted usually. Now, the actual misstatements you find, those you can tell them, hey, look, here's an account for $9,000 that really should be $7,200 or whatever it is. So these are, the immaterial misstatements. I should say all statements, including immaterial ones. Just to correct their records, Okay, review the engagement. This used to be not that big a deal, now it kind of is. Review of the audit may occur after the audit report has been issued. So that's for AICPA. PCAOB, oops, for issuers. The review of the audit be completed before it is issued. Okay. Let me see something here. So a little bit different here in that the AICPA says that someone can review the audit after oops. Underline the wrong word. After the audit, whereas the PCAOB says it has to be done before the audit report is issued. The AICPA, I'm sure, does this because of the time it takes to have it reviewed, but for the big companies, it's worth the extra time. I guess the PCAOB would say to get it, make sure it's right before it goes out. All right. The audit report. Okay, the audit report, including the opinion, is released with the client's financial statements. It's not done in the audit in the annual report, which we will look at shortly. I might get rid of this for now so we can get it up on the same screen. Okay, conflicts between the annual report and the financial statements. And this would be a good time for us to look at the annual report. I think I sent it. Oh, I didn't send it out. Yeah, I did here. If you look in your email, you should have annual report for Target. And this is kind of what the annual report looks like. Blank, no. They'll still have a number of things, financial summary, and they'll have all this other stuff in there. There's a whole bunch of information in here that they'll have. And about halfway down, somewhere around, how many pages do we have here? 82, somewhere around 40, they'll have the financial statements. And a little bit longer. Oh, here's the page 42. Report of management. This is the management accepting responsibility for the financial statements. Here's the opinion by the CPA firm. Let's see who their CPA firm is. There are critical matters with Ernst & Young. And this is a report on internal controls. Publicly traded companies, they have to have an audit on the financial statements and the internal control. So here's the internal control audit. Our opinion.
Professor, I have a question. On the financial statement at the bottom of Ernst & Young, it said we have served as the corporation's auditor since 1931. Target's been around that long?
It could be that they're through mergers and stuff like that.
Oh, okay.
Yeah, yeah, and you do find stuff like that. Oh, I can't remember who it was now. I'm trying to think. I'll have to look it up, see what the old one. I think that was it GM or something like that, that they had the same auditors for over 100 years. So and by the way, this is only for the US companies are the ones that are firms are, you put this in. But yeah. Okay, now here's the financial statement. So this is what they wrote up their audit report based on these financial statements. All right, so here's the financial statements that they audited. Go through them. There's a balance sheet. Financial position is the same thing as a balance sheet. Assets, liabilities, equity. Statement of cash flows. Okay, so these are the financial statements. Now, here's what can be a problem. Let's go back up here to trying to find some numbers. Okay, so here's some numbers that they give just in the body of the annual report. There was a better one here. So they give all these, some of this little pieces of information here. Now, here could be the problem though. Here's sales by whatever. What happens if the information they're giving up here doesn't match the financial statements? Right? I mean, what happens if it's a wacky report. Maybe it's my browser. Trying to get the I saw a summary up here somewhere. Oh, well, it's gonna be up here. Well, here, let's go to this thing here. So suppose that they have something in here that doesn't match up with the financial statements. They say they have more revenue than they really had. Or they say that their operating income was more than they really had, or less than they really had. If something doesn't match up, what do you do? So, notice there's a problem here. You're only reporting on the financial statements, and the financial statements are fairly presented. However, the financial statements aren't matching what they have in the rest of the audit annual report. The numbers they give are different. Or maybe they give things like ratios and the ratios are wrong. What do you do as an auditor? Here you have these financial statements that are fairly presented, but sitting right next to them is misleading information. Right in the annual report, and with big, glowing pie charts and all that kind of stuff, you have something that is not correct. What do you do with that? Okay, so that's what we're talking about here. Conflicts between the financial statements and the material released in the annual report. Now, this is only if it's material, obviously. Oops. So So when a material conflict occurs between the financial statements and the annual report, the auditor may, one, withhold the report. Two, withdraw from the engagement. And the reason being is that this is considered misleading, and we cannot be held responsible for that. Now, hopefully, you know, the threat of one of these two things will snap management out of it and get them to have their information in the annual report match up with financial statements that you reported on. Any question on that? There is a third one that I don't think they're very happy with, but the third one is that you can actually reference it in the audit report. The problem with doing that is that's a moving target, and because these same financial statements will appear in later, 2021 financial statements will appear in 2022's annual report also. So there's a problem there in that it won't be referencing the same annual report. Or the same, same annual report, that's right. So I would say that's a third one, but that is, again, I think that one's sort of frowned upon, and that is indicating our report as what they call an other matter. Another matter, in other words, that doesn't directly relate to the financial statements, but it is something for people to know when they're reading. But these first two are the ones that the AICPA are more keen on. And the reason being, hopefully, that it'll get whoever's issuing these financial statements or the annual report to fix it. Okay. Reports and opinions. We've already gone over these a little bit. There's a few more things we're going to throw in here, but there's two areas that they have kind of gotten added on to the annual report. So we're getting reflection. There's two things that got added on to the annual report. One for the AICPA's annual report, and one for the PCAOB's. I shouldn't say annual report, audit report. And so we're going to go over those a little bit more than some of the other stuff, but okay. So unmodified opinion, and they give some, for an unmodified opinion, these are the terms that have to be met for you to give an unmodified opinion. And yeah, so you can read through these. They're not anything terribly difficult. Now, there is this new one down here. Key audit matters. These are something that can be added on to the end of an opinion, which we'll talk about here in a little bit. But key audit matters are generally things that are related to the audit process and not necessarily the financial statements. So it could be, you had trouble confirming this or that, or estimating this amount or whatever it was. We'll talk about that in a second. That's the new thing for it. So here's the independent auditor report. Yeah, I think we said, mentioned here, it goes to board of, or shareholders, board of directors, usually people who are not, it does not go to the management of the company. They made the financial statements, they should already know them. Opinion, in our opinion, we've already gone over a lot of this prior classes. And when you take the CPA exam, you're going to go through the step by step. I think I don't know if I told you or not. When I took the CPA exam, we used to memorize. It was a little bit shorter than it is now, but we had to memorize it because sometimes they'd say write the standard unqualified report, and so we'd have to do it. And the nice thing is, if you memorized it, you knew that you passed the CPA exam because about half people wouldn't. So just by the numbers. But anyway, when you study for the CPA exam, what I do is I go through this whole thing and I do it sentence by sentence to kind of get keywords so that you realize what's in that report. Because a lot of times they have the questions, they'll say, which of the following is not included in the audit report. And so if you have those memorized, it's not too bad. If you have to try to think about it, it can be a little bit more tricky. Taking the CPA exam, we try to stuff as much stuff down to the lowest level as possible. So memorizations are really big. You don't want to have you jumping through mental hoops when you're taking it. Okay. Permanent non-concurrence gap, and they talk about this. Big thing is they talk about judgment. We've talked about before, all auditing is judgment. Okay, key audit matters. And this is not required. However, it might be there if management wants it. It could also be there if, and usually if management wants it, a lot of times it's because somebody else wants it, like the bank wants it or something like that. And again, these are usually, they go into the process of doing the audit, not necessarily the result of the audit. They'll explain how they came up with, certain estimates and things like that. So it's a little bit different than the audit and reporting on the financial statements themselves. These are usually things that are, well, they happen during the audit. They're usually about the process of the audit rather than the results of the audit. Okay. Yeah, so here's a signature, city and state, all that kind of stuff. All right, coming down here to the unqualified standard report for publicly traded companies. A lot of it is basically the same. Instead of accepted auditing standards, we have the standards by the PCAOB. Critical audit matters. So notice we have key audit matters for the AICPA, key audit matters. And then we have critical audit matters for publicly traded companies. And again, you see, this is also the same thing, more of the process. It relates to the accounts disclosures that are material to financial statements and involve our especially challenging subjective or complex judgments. Notice that this is kind of laying it bare, is that this is what we had to go through to get to the end result. It does not mean that we're going to change the audit opinion. That's going to be the same. But this explains kind of how they came about with certain judgments. And actually in the audit report here, we can actually look at and see they actually, almost all big companies have those. Let's see if it's, I saw some in here, I know they have them. Yeah, Okay, so here's critical audit matter. So here they give you a description of the matter. What was the description of the matter? Okay, it looks like they had something. It looks like they had a problem with a high volume of stuff for the inventory. They talk about how they address the problem. And down here, they have another one for vendor. So you give a description and then you say what you did. So right here, they'll say, to test the income from receivables, we perform procedures that include, among other things, assessing, blah, blah, blah. Okay, so again, it is more of the process rather than the end results. And the idea is that this will give more insight for people that are reading the financial statements. Okay, critical audit matters. Estimates are always a problem. Material risks. Insignificant risks. Blah, blah, blah. You can read through these. But anyway, so these are just some of the things that, that we could be in there. And they give a description. And of course, they also give a kind of resolution. Here we have this. We have served as the company's auditor since whatever the year is. Okay. So these are just kind of the multiple choice things we're going to go through. And we haven't talked about all these things, so we'll talk about them now. Standard report for a non-public client has all the following elements except. So this is a non-public client. Anyone hazard a guess which one of these is not? So this is a small company, a small business. You want to guess which one we don't cover? This one. We don't give an opinion on internal control. A lot of times they don't have any or very little internal control. So a lot of times we won't have a opinion on internal control. If they ask for one, you can, but generally speaking, the standard report does not have anything to do with the internal control report. They're two separate things. Okay, the standard report for public client has all the following elements except. So this is for an issuer. You want to guess which one? No. Well, a publicly traded company, they're going to be following the PCAOB rules. So they're not going to reference the AICPA standards. Okay, emphasis of a matter. And emphasis of a matter is it's something that's already been reported. And what you're doing is really emphasizing it. So you're telling the reader, oh, by the way, look at this. So it's already been reported, but you're putting it in your audit report to tell the reader that it is important, pay attention. It's already been reported, but this is, an important note. Going concern is one. I think we talked about this. I can't remember. It's when a business will likely go bankrupt. So we're looking for what it's not. And this one is very tricky. So tricky. My first time reading it, I thought I didn't have it in there, but this is it. And I'll tell you why this is tricky. It's now, it used to be within 1 year. Now it is at least 1 year. So the new standards are, the time frame you say, well, are they going to go bankrupt within 1 year? Now use at least 1 year. You might go out 2 years or even 3 years. It's open-ended. It doesn't say how long to go out. So this is the new, I have to say new, not now. Okay, so the rest of these are all true. When a company's going bankrupt, they use the terminology substantial doubt. So there's substantial doubt about them continuing as a going concern. It's required in statement of disclosures in the footnotes. So this is already reported. You're simply drawing attention to it. You're saying, look, by the way, in the footnotes, it talks about that this company might be going bankrupt. This is important, but it's already reported in the financial statements. And auditors may consider management's plan. So it isn't just that a company's doing poorly, it's usually they're doing poorly and they don't have a plan to get out of it, or their plan that they have isn't very likely to do anything about it. So if management has a plan, okay, yeah, we know we're doing bad, but here's what we're going to do. We're going to sell off this building. We're going to sell off this, business, take that money and, pay down our debt. And, if they have a plan and it looks feasible, you can consider that. If they don't have a plan, or if they have a plan that's not very reasonable or likely to keep them from going bankrupt, then you still give them a going concern. And a going concern paragraph, it doesn't change the opinion. They can have a clean opinion. A company going bankrupt can have a correctly prepared financial statements or fairly presented financial statements. However, that paragraph can really be, a death sentence for a company, because if you put in there, this company is likely to go bankrupt, they're not going to get financing. So it's one of those weird things that sometimes, it is possible that the audit report would actually trigger a company going bankrupt. And that, you need to get into a little bit of legal matter here. And, it's not unusual for you going concern and the auditors get sued. As I say, if you put that in there, we will go bankrupt because we won't be able to get financing. But you're required, if they have a, if they don't have an adequate plan, or if they have no plan, then you're required to put that going concern in there. It's a required emphasis of a matter. There was a little airline that was going bankrupt, and they got this going concern in their paragraph, and they came out saying, the auditors are wrong. We're doing this, we're slashing this, we're selling this route and all this stuff. And I remember they went to the auditors for comment, and the auditor said, well, if they had that plan in place, they may not have gotten a going concern. But they didn't have anything in place, and so you have to go with what you have. Sometimes it's kind of a wake-up call for a company. Really, we're going bankrupt? Yeah, you're going bankrupt. You're gonna be out of cash in 6 months. Emphasis of a matter. I think there should be a dash there. Paragraph has been issued for generally accepted accounting principles not consistently applied. Okay, so this is when they are using GAAP, but not consistently. Let me give you an example. I'll go down here and give an example. So switching from LIFO to FIFO. And maybe they switch from LIFO accounting to FIFO accounting. These are both GAAP. So not consistently applied does not mean they're not using GAAP. They are using GAAP. It's just that it's not consistent from one year to the next. So this is. Okay. This one's also tricky. Is use of management changes from an accounting estimate? No, estimates are not changes in GAAP. If is used if management adopts an unacceptable accounting rule? No. If it's unacceptable, it's not GAAP. So this is a switch between GAAP. Must be used even if the financial impact is immaterial? No, if it's not material, it's not going to matter. So by default, it's going to be this last one, but let's read what it is. Just we came all this way, we might as well finish it out. If is used even if management justifies the new principle is preferable, and this is the one. You know, a new, for instance, maybe a new accounting rule comes out, they switch to it. They are going to get this in the audit report, even if they're doing it absolutely right. And but quite honestly, they don't really care usually about that. I don't think they have any of those over here. Do they have any of those? I'm just looking in the I don't know if they have them. This is kind of unusual. There was a period of time we had a bunch of rule changes. It was like 10 years ago or something like that. I remember seeing one company that had 6 of those. They had 6 of those GAAP not consistently applied because they had a whole bunch of new rules come out. A new accounting rule comes out. Well, you weren't using it last year. It's brand new. So you're using the GAAP rule for this year. Doesn't match the one from last year. So they put it in the audit report, and it was very common. I mean, it wasn't, companies didn't get mad about it or anything like that because they're both. It didn't say that they're misstating anything. It's just that it goes in the audit report for not consistently applied. Okay. Other matter. Now, these are audit discretionary, and these are actually relate to the audit, unlike the key material, critical audit matter or key audit matter. These actually relate directly to the financial statements usually, and are used for uncertainties which have the following characteristics. Normal uncertainties? No. One's going to be reasonably estimated. No, if they're reasonably estimated, you put them in the financial statements. It's this one, unusual uncertainties. Is required? No, these are discretionary. The auditors do not have to do them. Notice that's different than these up here. Emphasis of a matter. These are required. They can also be discretionary, emphasis of a matter too, though. But these other matter ones are completely discretionary, and these are up to the auditor whether they want to put them in or not. And other matter, paragraph that is issued for additional circumstances may include all the following except. So which one of these is not probably going to be that big of a deal? B. Inventory item that could not be verified, that would be a part of the audit process. It could be in a critical audit matter, but that is not going to be an other matter. Usually there are big things that happen. Significant related parties, major catastrophe, an important subsequent event. Those are things that are big, and those would be things that we put in the other matter. Generally not something fairly routine. The inventory could not be verified for whatever reason. Okay, group auditors. I'm just going to push through. I think we can do this within. But let's shoot for 7. Come on, guys, you with me? Group auditor and component auditor. I don't think I talked about that in here. And I think I'm going to a little. Okay. Sort of like this. You have a parent company. Oops. Eh. Come on, you straighten out. And they own a subsidiary. It's not very good. Okay, so that pen's even worse. So they own a subsidiary. Okay, so the parent company, let's say they get an audit, and their audit is done by CPA firm A. Down here, the audit is done by CPA firm B. Now, you'll notice something. This subsidiary is part of the parent company's financial statements. I mean, the consolidated financial statements, they also have income, or losses coming from this subsidiary. So notice something here. This subsidiary is going to be counted up here. And so the question is, if you're the CPA firm A, you're going to do bring your audit report, but it includes this subsidiary that's audited by somebody else. So the question is, what do you do with that? Well, you have, in the United States, you have some choices. And one is that you can, reference firm B in the audit report. 2 is that you do not reference If you don't reference firm B, you take on all of the responsibility. Subsidiary. Okay, so you can reference firm B, split up the audit report saying we audited this company, CPA firm B audited this subsidiary, or not. If you don't reference this other company, you are going to take on all the responsibility, or this other CPA firm, you're going to take on all the responsibility for the parent company and the subsidiary, and you probably have to do some extra work here. Now, here's the weird thing. So this is only in the US. International standards, you cannot reference another firm. You have to take a full responsibility for everything. So US only, you can reference the other firm. Other countries, you can't. International standards, you can't do it. So the group auditor, this is for the parent company. And then the component auditor is for the subsidiary.
Would it be A?
Which the following is not true.
Not true. Oh, okay.
Oh, I know. Let me go back to the other thing I was just showing you. Now, here's another thing about this, though. Materiality for this parent company, big company, they probably have a much higher materiality. I'm just going to make this up. Let's say they have $100 million of materiality. Okay, big, whatever it is, IBM. Now, the subsidiary is probably much less. Maybe theirs is, I don't know, say 500,000. So when this audit firm B audits this subsidiary, they're using a materiality of 500,000. When this CPA firm is auditing the parent company, they're using 100 million. Now, notice that there could be definitely something that is material down here. Maybe they have a misstatement of $2 million down here that's very material to this little company. It's not material at all to the big one. So you do have a lot of times a mismatch in the materiality, whatever it is. There's a little bit of extreme there, but you get the idea. Okay, so having said that, which one is it?
I'm going to go with C.
Yep. Yeah, they might be completely different because the parent company might be much larger than the subsidiary. And you are never forced to rely on the component auditor's work. So if you don't trust the component auditor for whatever reason, or that maybe your client doesn't want you to do the extra work, you have the option of doing it. It's your audit. You can disregard it and do what you need to do to make sure that overall the parent company's financial statements are not misstated. Okay. We need to jump right down here. Let's go to these. We've already gone through these, I think, before, didn't we? We talked about these, didn't we? Qualified opinions and adverse, and I think it was on a test, wasn't it? Shouldn't I know these things? Did we talk about these? We'll go over them. Okay. Qualified opinion. Material misstatement. Second. That is not pervasive. So it's when you find so modified opinions, these are usually bad. Usually. There's material misstatement, but it's not pervasive. Usually can find one or two accounts. These are often called except for opinions. And they're called except for opinions because they always say everything's fine except for, and then they tell the bad stuff. So in the business, you'll hear these called except fors. Adverse opinion. Treatment statements that are pervasive. The financial statements cannot be relied upon. Well, let me bold this for a second. Bold all these. Oh, financial statements cannot be relied upon. They're not GAAP. They're not fairly presented. And this is the worst opinion. Now, for both the qualified and the adverse, for both of these, we put the dollar amounts in the report. And this is, they're put in there for a number of reasons, but first of all, it's part of it is to get the company or the client to fix the financial statements. It isn't like nobody's going to know if they refuse to put it in the financial statements. The dollar amounts will be right in the audit report. You know, this is off by X amount of dollars. This is off by X amount of dollars. So there really is no advantage for a client to ever get an adverse opinion. it doesn't do them any good. And in fact, it makes it look worse because it looks like they are trying to mislead people, which, basically they are. Okay, disclaimer of an opinion. Not enough evidence can be collected to form an opinion. So if you can't get enough evidence to form an opinion for whatever reason, they end up with a disclaimer. And really, a disclaimer is no opinion. And no opinions are like getting nothing. Okay, so qualified opinion.
D.
Yep. Adverse opinion.
C.
Yep. And disclaimer.
Evidence. Is it B?
Nope.
A.
Nope.
Oh, wow. B.
Let's see, misstatement, if any, is enough. You don't have enough information. You can't.
It's D. Yeah, it's a no.
You can't form a position. Oh, I know what I was going to tell you up here. Let me change this a little bit. Up here. You know what? That's I should have put this up here when I did this. So dollar amounts of mistake. But actually, I'm going on here next level. Dollar amounts of misstatement, if any, is unknown. Part of the reason you get a disclaimer is we don't know what the dollar amounts are. And if they ever do put dollar amounts in a disclaimer, is usually to the effect of, we can't verify, X dollars of sales or whatever it is. You don't have enough information. You can't put a dollar amount on it. So you have, they could be absolutely perfect, but you don't know. You can't get enough information. So a disclaimer really is no opinion at all. It in some ways it's not good, bad. It's just nothing. It doesn't tell people anything. Okay, scope limitations. Scope limitations are when you can't get enough information. And that's not me. It's still not me. Let's try this again. A scope limitation is when you can't get enough information. And they usually come in, well, now they've actually added a third one, but generally they come in two forms. Those things that are controlled by the client and those things that are not. So if a client doesn't want you to look at something, that's a client imposed. And that is the more serious of them. That if a client says, you say, okay, I need to count your inventory. No, you're not touching my inventory. You're not going to go near my inventory when we take it, Okay, that's a problem because we need to get that information so we can do that. So if a client imposes what they call a scope limitation, the scope being what you can look at, they say, okay, you can't look at that, it's a scope limitation. That's much more serious, and for a couple of reasons. Not the least being is whenever somebody doesn't want you to have that information, first thing that pops in your head is why? Why don't you want us to look at the inventory? Right? I mean, I think I was the murder case that please come to my house to investigate a murder. And I say, yeah, you can look anywhere you want, but don't look in this closet. Well, that's gonna be the first place they want to look is in the closet. So same thing, whenever someone tells you you can't look at something, that becomes more serious. Now, it could also be circumstance imposed, and they actually break this up now into two different kind of categories. Circumstance imposed is those things that are beyond the control of the client. So, you're trying to get their financial records. They had a big flood. Everything got ruined. The computers are ruined. The other stuff is ruined. You can't get the information, not because the client doesn't want you to get it, but because it's just not there. So that's a circumstance imposed. For circumstance imposed, you're generally a little bit more lenient. You say, okay, well, this isn't something they wanted to have happen. This is something that did happen. And whatever it is, it could be a fire, a theft, flood, whatever it was, something that has happened that you can't get the information. All right. And that one, you have a little bit more leeway because that doesn't usually arouse, unless there's fishy circumstances or something like that, but generally, if it really is circumstance imposed, it doesn't arouse the same suspicion as don't look in the closet. That is, it's a lesser degree of uncertainty, and you're given a few more options generally if you have that. Okay, which scope limitation is considered the most serious?
B.
Actually, C is going to be it. And I you know what? I didn't finish what I should have. I should have talked about B. I didn't talk about B. The B is the new one, which is probably why I forgot it. So circumstance imposed limitation due to the nature and timing of the audit. The auditors are hired after year end. Okay, so let's say you're hired after year end. Well, there's a problem with that. Now, the problem is the let me highlight this. This is the answer to this one. But if you're hired after the year end, notice we can't jump in the time machine and go back and count inventory. So sometimes you have to, possibly take inventory later and then try to back into what the ending inventory was. But a circumstance imposed scope limitation, again, is generally less than a client imposed. So client imposed ones are the worst. That's when a client refuses to let you see information. Whenever there's a circumstance imposed one, while you're probably not happy about it, it's less ominous than a client imposed. And again, when a client imposes a scope limitation, you have to wonder why. I don't know if I told you, I probably already told you this old story, but I had a friend who did an audit of this company that made juice. They made these it was like a regional place that, and they had designs on going public and all this kind of stuff. But they made this juice, and they had secret ingredients. Well, whenever you're talking about secret ingredients, you got to wonder, well, okay, so they're putting secret ingredients into this juice, whatever it is. How much does it cost? What, you know, if you want to do the financial statements for it, you have to know what it, you know, how much they cost. Now, there are ways people keep, ingredients secret. You don't, for instance, a lot of times places will buy and sell large quantities of stuff that does not go into their product. Why? Because they want people knowing, you know, if they know that you always buy whatever, salt, lemon juice, and whatever, you know, they can figure out what your secret ingredient is. But if you buy all kinds of stuff, they don't know. So it's not on, you know, it happens all the time that they have secret formulas. Coca-Cola is a secret formula. Pepsi is a secret formula. Kentucky Fried Chicken is a secret formula. So it's not unusual. But what is, so they were asking about the cost of this, and the owners refused to give it to them. They said, no, we're not going to tell you what it is. And so, you know, they they kind of both got pounding on tables, and they ended up getting a disclaimer because the owners refused to tell them, you know, what was in there. And of course, you know, you can't go public if you have a disclaimer of an opinion. You have to get basically a clean opinion to go public. So it was really kind of a strange situation. But and you know, they didn't know what the cost of it was. Well, what was the cost of it going in? And if you don't know the cost, you don't know if they're profitable or whatever it was. Okay, a scope limitation that is deemed to be possibly material and pervasive should have which type of opinion? And that would be a disclaimer. Actually, it'd be a disclaimer, because remember, this is that you don't know.
Oh, yeah, I said D.
Oh, you said D. I'm sorry. Yes, like I said, that's correct. Yeah. Well, I'll go through my spiel again. Yeah, the adverse and qualified mean that you do know. A scope limitation means you don't. So, yeah, no opinion, because you don't. It might not be misstated at all, but it might be material and it might be pervasive. Okay. A scope, actually, there's two answers. There's two answers for this one. A scope limitation is deemed to be possibly material but not pervasive should have which type of an opinion? There's actually two of them that we could do here.
Not GAT.
No, actually, it would be, well, we give them a disclaimer.
Mm-hmm.
You know, we're talking about so this is one of them. We can also give them a qualified, because this is not pervasive. Or, you know, likely not pervasive. And this is generally also when they are, it's a circumstance imposed usually. And a qualified, except for opinion, while it's not the ideal opinion, it's better than no opinion, because an except for says, okay, except for this, everything's okay. You know, financial statements are fairly presented, except for this. Whereas a disclaimer is no opinion. Now, a qualified opinion, again, while it's not the best opinion, you can actually go to the bank and say, look, you know, they couldn't verify our inventory in this location or whatever it was, but everything else is fine. You know, our sales numbers are right, though, you know, blah, blah, blah. So a qualified opinion is better than a disclaimer. And so it is possible that you give a qualified opinion if the scope limitation is possibly material but not pervasive. And by the way, I think I talked about this before. You're not rooting for your client. Oh, I'm going late. I'll talk faster. You're not rooting for your client, but at the same time, you want to give them the most benefit to the audit that you can. So a lot of times, a qualified opinion, again, while it's not a clean opinion, it's better than a disclaimer, because at least you can go to the bank and say, look, the financial statements are fairly presented. You know, there's this thing they couldn't verify, but all these other numbers are, you know, reliable. Okay. Last one. Okay. No, we don't. Last thing for the class. A scope limitation that is deemed to be not material and not pervasive. Which kind of opinion? So it's not material. and it's not pervasive.
Would it be A?
Yes, good. Yeah, if it's not material, it's A, standard. So a scope limitation, just because there's a scope limitation, doesn't necessarily mean that they don't get a clean report if it's not material. Okay, that is it. Question on that? Okay, so I am going to send out the chapter 16, 17 exam again. This is a little 2 pages, basically definition kind of stuff from 16 and 17. And that'll be the last thing in the class. Let me get rid of this. Any questions? And we're done early. All right, so yeah, so I'll send out that the last exam, which again is this is a 2-pager, and you just go to 16 and 17, just basically definition stuff, and that's it.
Professor, when would that be due?
It's due on the 16th,
The 16th. Okay.
week from
All right.
Friday, and I will be here next week. It's not required. This is completely optional next week, but I will
Okay.
be here in case anyone has any questions. You want to go over anything, you know, whatever it is. Okay.
All right. Thank you so much.
All right. Thanks. Great having you guys. And I maybe will see you next week, or maybe not. All right. See ya. Oh, what am I doing?
Have a good night.
Oh, thanks. Good night.